2028 to through 2030. I've said $5,000 gold and and triple digit silver, but we hit both much sooner than I would have expected. People need to get used to this new pricing regime that we're in. We're not going to see $2,000 gold again or $25 silver again. We're very much industrial driven, with silver being deemed a critical metal, and then people waking up to the fact. You start bringing in hedge funds and investors. That final move from the 90 range up to the 120 range was all short covering. We can now watch all these juniors start to develop assets, because we can't do it all our own. Raise money, which we don't. We've got $1.2 billion in the bank right now. So it had a 7-year mine life when we bought it. And it was producing 2.5 million ounces of silver at the time. It now produces 10 million ounces of silver. It's got 11-year mine life. This is underground mining. You're lucky to get 4,000 tons of ore out of the ground a day. Our next goal is to get through the 50 million ounce silver equivalent.
So the last time we spoke was on Boxing Day, and at the time, silver was kind of gapping up, I guess would be one way to put it. Your concern at the time was that it was going up too fast, and you didn't know what would happen after that. Shortly after that interview, we hit over $120 and then crashed, and now we've sort of been hovering in sort of a $70 to $85 range. You've been doing this for a long time. You're obviously talking with end users of silver. What's going through your head? What do you see right now?
Well, I'm a big believer in charts, and I like the way the charts are looking. We did have this parabolic move up to the 120 range, and it had to correct, and it had a pretty violent correction, as we all know. And now it's kind of leveling out here, and people need to get used to this new pricing, regime that we're in. We're not going to see $2,000 gold again or $25 silver again. We're in a completely different price environment, and which is setting itself up for much higher prices in the future. But we need to just kind of have this market cool down a little bit into the summer months, and it's often. April, May, June are quiet anyways, so it's pretty common. So that's what I'm expecting.
What looks like a pause in silver may actually be the market trying to accept a price level most investors never believed could hold. As Keith Neumeyer points out here, the violent drop after $120 did not destroy the larger structure, because silver still remains nearly 3 times above where many miners once modeled long-term production. The more important signal is that buyers did not abandon the market even after a brutal correction. That usually tells careful investors the speculative excess has been flushed while stronger hands remain. Next, Keith Neumeyer discusses why this quiet consolidation could matter more than the earlier breakout.
So what do you think drives us higher? Do you think that the industry itself, I mean, what are we in our 6th year of a deficit, assuming it's going to be the 6th year of a deficit, that's just going to naturally drive the price higher? Do you think that it's the general geopolitical or macro environment? What do you think takes us higher from here?
It's what took us, I think, to the levels where we're at now is very much industrial driven. With silver, being deemed a critical metal, and then people waking up to the fact. You start bringing in hedge funds and investors, and that final move from the 90 range up to the 120 range was all short covering. People were in a lot of pain, as you can imagine, on the long side of that point, and then or the short side, pardon me. And then everyone on the way down got hurt on the downside. So I'm not sure who made money on that big rally, but I can assure you not too many people did. So it came completely unexpected. But as I'm thinking this is just the beginning, and we're going to see much higher prices in the years to come. But we may need to wait it out here 2028 to through 2030. I've said $5,000 gold and triple digit silver, but we hit both much sooner than I would have expected.
I think I saw you the day that silver hit $100, and you looked at me and smirked and said triple digit silver. It must have been a nice validation to to at least have touched it.
Yeah, that was at VRIC, right? People were
Yeah.
high-fiving me and waving at me, and it's pretty funny. But yeah, it took a long time, and so I'm getting out of the prediction game.
That being said, do you think that this environment is going to drive more mines coming online?
You know, what it's doing is it's financing the junior space, which is something we've not seen for a long time. You'd have to go back to, oh 04, 05, 06 to really see a comparison to where we've seen so much money coming into the junior space. I'm talking about the small explorers that have had no money for over a decade, and they've just sat on projects and haven't been able to do anything with them. Now they're actually getting finance and drilling, and that's great for companies like First Majestic because we can now watch all these juniors start to develop assets, because we can't do it all our own.
A 6-year supply deficit matters, but markets often move hardest when investors suddenly realize a shortage was ignored for too long. As Keith Neumeyer points out here, the last push higher was not only industrial demand, but forced short covering, which often exposes how badly large traders misread physical markets. What stands out is his warning that very few participants actually profited from that surge, showing volatility can punish both optimism and skepticism. When junior miners start attracting financing again, that usually signals capital is quietly preparing for a longer cycle. Next, Keith Neumeyer talks about what that capital shift could mean for producers.
We need these juniors to do that work, and we keep our eyeballs out, and it creates M&A opportunities for us. So it's great to see that whole layer within the sector get financed. For the bigger guys, like First Majestic, it affects us less, because we've got relationships. If we ever needed to raise money, which we don't, we've got $1.2 billion in the bank right now. So we're not going to be raising any money, but nevertheless, it's really good to see.
So you guys recently put out your Q1 production results. What can you tell us?
Well, another great quarter. Generated a ton of cash. It's just it's pretty crazy how much cash is coming in the door. Costs are being held in reasonably. I know the financials aren't there, but yet you've just got the production numbers. But no, it was a bang up quarter, right on track.
Well, actually, I believe you guys tracked ahead of guidance for both gold and silver. You think that this is going to continue, or was guidance sort of weighted to the front half of the year?
Not really. No, I think it's we ended off Q4 very strongly, and that kind of went into Q1 as well. And some grades were higher than we expected. Cantada is doing well. All the mines are doing actually quite well.
Strong commodity prices can hide weak operators, but cash flow usually reveals who is actually built to survive the next downturn. As Keith Neumeyer points out here, holding $1.2 billion in cash gives his company flexibility that many miners still do not have after years of diluted growth. Investors should notice that production beat guidance while costs stayed contained, because margin discipline often matters more than headline ounces. When management can fund expansion without begging the market for capital, that changes the risk profile dramatically for shareholders. Next, Keith Neumeyer discusses why operating strength matters more than many investors realize.
It's nice to have 4 mines operating, and they're all operating at or slightly above budget. It makes a huge difference. And we operated above 5% above budget in Q1, and we're looking at around the same for Q2.
So you guys also recently moved away from providing a silver equivalent figure due to the volatility in metals pricing.
Mm-hmm.
How should investors sufficiently assess the performance on a quarterly basis in terms of production moving forward?
Well, it's not always just production. It's costs and cash generation as well. We're able to produce less metal today and make more profit. So why sterilize the mines? Why go chase high grade when you don't need it? How the high grade is there to take care of days that are weak, not take care of days that are strong. So we're mining a lot more low grade, so we're staying in the mine longer in a certain area, and we're mining wider. So rather than mining 3 meters out from an underground tunnel, would take 5 meters, because the wall rock is now all of a sudden economic. So what's that? That's done. It's extended the life of the mine, by call it 20%.
Sometimes producing less metal can create more value, and that is where many retail investors misread mining companies. As Keith Neumeyer points out here, focusing only on silver equivalent numbers can hide the real story when higher prices make lower grade rock suddenly profitable. Extending mine life by roughly 20% can improve long-term valuation more than a short-term production spike that burns through premium ore. That shift from volume to profitability shows management is thinking beyond the next quarterly headline. Next, Keith Neumeyer unravels how mine strategy can quietly reshape future shareholder returns.
Because you don't have to go as deep as fast, so you can mine a lot slower and wider, but your costs do go up a little bit because you're pulling out more rock, and it is lower grade rock, so your recoveries tend to be a little bit less. But when you add it all up, you're mining more rock, your costs have gone up a little bit, your production's about flat. It could even be down a little bit, but your top line has grown quite a lot, and your profits have grown quite a lot. So we measure this all the time.
The company also saw a big boost in the latest reserves and resources update after heavily committing to exploration in 2025. Is this strategy based on an effort to increase mine life, or is there a bigger move at play here where you're aiming to increase output but want the ounces in the ground first?
Yeah, Steve, I think that's really more the focus. We would like to expand the mills. We are doing 2 small expansions this year. We're taking Santa Elena up from 3,200 to 3,500 tons a day, and Gatos up from 3,500 to 4,000 tons a day. They're both. Well, Gatos is very much restricted by underground mine development, so that's where the focus has to be is developing the mine.
Higher costs usually scare investors first, but sometimes rising costs are exactly what stronger long-term discipline looks like underneath the surface. As Keith Neumeyer points out here, flat production can still translate into stronger profits when wider mining zones turn previously ignored material into economic ounces. Many investors still focus on quarterly output, while management is quietly building a longer runway that can support future mill growth. Expanding from 3,200 to 4,000 tons per day may sound modest, yet those steady increases often protect shareholder value better than reckless expansion. Next, Keith Neumeyer discusses why exploration success can completely change a mine's future value.
In the case of Santa Elena, it's mill restricted, so the mine can handle getting more to the mill. So there's slightly 2 different issues, but nevertheless, we have to give our exploration team a serious pat on the back. You look at the discoveries at Santa Elena. They had 3 major discoveries in the last 18 months. The Navidad discovery, which has now got a resource of 60 million ounces on it. That's combined with winter. Then you've got the Santo Niño discovery, which now has a resource of, I think, 27 million ounces on it. And these are, within 18 months of discovery. It's still building. We're pretty excited about Santa Elena. It had a 7-year mine life when we bought it, and it was producing 2.5 million ounces of silver at the time. It now produces 10 million ounces of silver. It's got 11-year mine life. And probably with the addition of Santo Niño and these other discoveries, it's probably past 20 years. So it's a major asset for us. And
how many ounces are you aiming to prove out at these discoveries before it makes sense to start mining them out?
Well, it's not that simple. These aren't open pits, right? You don't just have a big hole in the ground where you can send a bunch of trucks and pick it all up, and and then you need a big enough mill.
The market often rewards new ounces quickly, but it rarely prices in what a longer mine life can quietly mean. As Keith Neumeyer points out here, one asset moved from a 7-year life to a possible 20-year operation after multiple discoveries in just 18 months. Growing from 2.5 million ounces to 10 million ounces annually changes the valuation framework far more than a temporary price spike in silver. Investors who only watch metal prices can miss when operational leverage starts becoming the real story behind a company. Next, Keith Neumeyer unravels why underground constraints matter more than headline resource numbers.
No, this is underground mining. You're lucky to get 4,000 tons of ore out of the ground a day, and that's a reasonably good size mine, 4,000 tons. And so then you got to get into the mill, you can't expand it. It's just simply not expandable. If you want to, well, in our case, because this is related to your earlier question, so if you do want to expand the mill, you want to know that there's enough resources there in the ground to take care of that investment. You're not going to expand the mill for 1 or 2 year investment. If you've got another 10 years of ore in front of you, sure, it makes sense to expand the mill. But and those are the kinds of things that we're looking at doing.
Got it. So there's a fair bit of exploration work still to do before we're going to see production. But obviously, being able to put up resources of that size is an incredibly positive sign.
Well, these are big land packages too, Steve. You've got Los Gatos with 103,000 hectares. That's over 250,000 acres. You've got Santa Elena, 102,000 hectares. San Dimas, 75,000 hectares. These are big, chunky projects. You'll never drill them out. It's impossible. And there's always places to drill.
Yeah, and I have to tip my hat to you, because the first time we spoke, I think it was 5 years ago, we were kind of just learning about mining, and we saw the reserves that you guys had listed on the website and in the investor presentation, and that was the big question we had for you. Is you guys are mining quite a bit of silver here, but the reserves are depleting fast. And the first time we had you on here, your reaction was, we got a massive land package here. We've got a whole bunch more silver to go and discover. And here we are. You've done exactly that.
Money and time.
Wall Street loves simple production numbers, but underground mining almost never follows the simple story analysts prefer to sell. As Keith Neumeyer points out here, even a 4,000 ton per day mine can hit physical limits that money alone cannot easily fix. That means reserve growth only matters when those ounces can realistically support expansion over another decade or more. Massive land packages can look abstract on paper, yet they often become the hidden inventory the market consistently undervalues until scarcity forces attention. Next, Keith Neumeyer talks about how capital allocation shapes the next stage of growth.
So I don't know if you can enlighten us on what attracts you right now about the equities market, but are there any other areas you're kicking tires at?
Not really. I do have some of my favorites I am buying on weakness. But I really taken the last year plus to get rid of some of my equity positions I've had for quite some time, and I'm up on them, and due to the current market environment, and but I have held some of these investments for a decade, so I have been creating cash over the last 12 months, and rotating some of that into some of my other favorite names. My position at First Majestic has increased over the last 12 months. My position at First Mining Gold has increased as well substantially over the last 12 months. And, I continue to support companies like Yukon Metals and Westward Gold, and there's a few others. But My portfolio is not that big. It used to be made up of, over 30 companies. Now I've got less than 10.
So we'll leave it with this. For the next year, if you and I were sitting down here this time next year and you told me that you've accomplished everything that you wanted to at First Majestic, what does that look like? What are those big milestones that shareholders should be watching out for over the next year?
Well, it'll likely never happen because I'm never happy. So, our next goal is to get through the 50 million ounce silver equivalent threshold. It took us 23 years to get to 30 million. And I think we can get up to 50 million within the next 10 years. I think that's a reasonable goal. And that's what we're trying to shoot for. And it's going to take two things. It'll take M&A, successful M&A, and also successful drilling and mill expansions. That's the two kind of legs of the business that we're very much focused on.
When an insider cuts 30 holdings down to fewer than 10, that usually signals conviction, replacing simple diversification. As Keith Neumeyer points out here, he has spent the last year raising cash while increasing exposure only to names he believes can outperform in a tougher market. That kind of concentration can tell investors more than public interviews, because capital tends to reveal real belief better than words. The target of 50 million silver equivalent ounces also suggests management is thinking in decade-long cycles, not quarter-to-quarter noise.